Hello, everyone, and welcome to another Wall Street from Main Street podcast. Joining us will be Elliott Gue from thestreetauthority.com and also Energy and Income Advisor. Elliott, welcome to the show.
Thanks for having me on.
You're welcome. I'm happy to do it. The first topic I want to talk about is the oil price differentials. Every time you get someone, they look at the price of oil on the exchange and they see, well, right now it's around $90, $91.
Right.
And then they look at the gas price and they go, well, how come the gas price is so much higher in terms of when you compare it to the price of oil? And what they don't realize is that there's so many oil prices. It's just the main one traded on the U.S. is WTI. Can you elaborate on that?
Yeah, that's absolutely correct. I mean, a lot of people talk about oil like it's a single commodity. The reality is that there literally are well over 100 different grades of crude oil traded around the world. And if we look at the global crude oil market right now, probably the two most widely quoted oil benchmarks are WTI, which is West Texas Intermediate, which is crude oil which is delivered to Cushing, Oklahoma, which is in the mid-continent of the U.S. The second one is Brent crude oil, which is probably the most widely watched international benchmark. And it's basically priced based on a crude oil grade that's produced in the North Sea of the United Kingdom. And if I look at those two oils right now, as you mentioned, WTI is trading around $90, $91. We have Brent crude oil trading up around $110 or $111. So that's basically a $20 per barrel premium to the price of West Texas Intermediate, or WTI crude oil. And in fact, if I look around the world as a whole, what becomes apparent is that WTI is kind of an aberration. The only crude oils that are trading around that price are landlocked crude oils. They're crude oils being produced in the center of the United States, such as the Bakken Shale of North Dakota, or in places like Western Canada Select, or WCS crude oil, also trading at a large discount. But if I look at crude oils that are traded near the coast of any country, really, they're trading much closer to Brent. So, for example, in the U.S., we have a grade of crude oil called Light Louisiana Sweet, or LLS. That's trading at almost exactly the same price as Brent. If I look at, for example, Midway Sunset, which is one of the main benchmark of crude oil prices in the state of California, that's trading at about $101 or $102 a barrel. So pretty much all crude oils around the world are trading at prices that are closer to the price of Brent crude oil than the price of WTI. And if you think about that, a price up over $110 a barrel, that's not too far off its highs over the last few years. And if you look at the price of gasoline or diesel fuel or any other refined product, they tend to track the price of Brent crude oil more closely than they do the price of WTI crude oil. So basically what that means is that only a few refiners in the United States really have access to these discounted crude oils. If you happen to be a refiner with a pipeline that can access, for example, West Texas Intermediate or Western Canadian crude, yes, you can get that price. You can actually use that crude oil at a discounted price or buy that crude oil at a discounted price. But if you happen to be a refiner on the East Coast or in the state of California or in Europe or in Asia, in all likelihood, you're actually paying prices much closer to Brent for the crude oil that you're buying. Therefore, the prices of gasoline and diesel tend to follow that price of Brent a lot more closely than WTI. So one of the biggest issues we're seeing in the United States isn't really the price of crude oil. It's the fact that there's not enough infrastructure to move crude oil from places like North Dakota or even Oklahoma or Western Canada to move it to the coast, places like Houston, where there's a lot of refining capacity. So when you look at the price of gasoline and you look at it in relation to the price of oil, you have to be careful to look at the right kind of crude oil. And in this case, it's really Brent you should be watching, not WTI.
Yeah. And one other thing about gas prices, despite the lower oil prices, do you also think the ethanol mandates also contribute to higher gas prices?
Oh, certainly they do. I mean, if we look at the United States as a whole, it's divided up into a number of different districts. And if we look at, for example, the state of California, that particular state has very different rules as to what can be in gasoline. So they actually have much more stringent requirements on, for example, the sulfur content of gasoline, the amount of ethanol that has to be mixed into gasoline. And California-compliant gasoline is pretty much only produced in the state of California. And so there are a number of refineries in the state of California. I believe right now there are about 14 total. Some of them are very small. But the problem we see in a state like California is that if one of those refineries goes offline, maybe for maintenance or maybe because there's a problem, like we saw, for example, last year, the Chevron refinery, which is in Richmond, California, which is right outside San Francisco, actually had an issue, and they had to take it offline for a little while. And we saw California gasoline and diesel fuel prices spike because there really aren't other refiners out there or anywhere around that can produce California-compliant gasoline. And the loss of one refinery meant there was a shortage of gasoline and a shortage of diesel fuel in California, so prices really spiked. So when you have a state like California that has very stringent mandates on the amount of ethanol that has to be blended in, or exactly the environmental or the emissions that come out of the gasoline, it can make a very big difference in terms of the price. And if you look at California gasoline prices relative to the rest of the country, not only are they higher on average, considerably higher, but they're also a lot more volatile. And we see the same thing play out in different parts of the country, that if there's specific ethanol blending requirements or specific fuel requirements in a particular part of the country, and there's a shortage of refining capacity in that part of the country, it can really contribute to higher regional gasoline prices than really where they should be. So I do think that's a big issue, is the individual requirements of different states and their ability to access oil from other parts of the country. And just not to pick on California again, but do you realize that California has no pipelines that can bring refined products in from other states? Zero. So the only way they can get refined product, if they don't have enough in state, is to import it by tanker, which of course is extremely expensive. So yeah, I do think that's a big issue as well.
Yeah, definitely. A lot of we wrote an oil report, and I would say around half comes from passes right through the Straits of Hormuz. And in fact, you were telling me before the interview how they have a significant amount that comes from Saudi Arabia.
Oh, that's absolutely true. And if I look at California, they consume right around 1.6 million barrels of oil per day in California. The U.S. as a whole consumes about 19 million. So they're almost 10% of U.S. demand right in California. And as I said, they don't have any pipelines from other parts of the U.S. So pretty much California crude oil supply is a combination of domestically produced oil. They are actually the fourth largest oil producing state in the United States. They produce about 530,000 barrels of oil a day. So let's say that's about a third of their demand. Another bit comes from Alaska. The problem there, of course, is Alaskan crude oil production has been declining in recent years and is also extremely high price. As we talked about earlier, crudes on the coast of the country are at a much higher price than, say, those produced inland in the middle of the country. So Alaskan crude oil tends to trade very much like Brent crude oil. And the third component of California supply, which is now half of their supply, is foreign imports. And their number one source of imports is Saudi Arabia. It accounts for almost a third of their imported oil from outside the United States. And if you think about it, that's actually different from the entire rest of the country. If I look at exports of oil from Saudi Arabia to the United States as a whole, it's been declining in recent years, even though it's been rising within California. And again, those Saudi crudes are much more expensive than crude oil produced in the middle of the United States. And of course, you also have that geopolitical risk there, that those foreign crude oils, those foreign sources of crude oil, tend to be a lot more sensitive to, say, unrest in the Middle East or unrest in North Africa. So yeah, that's another big problem, I think, for a state like California or a country that's more reliant on imported crude oil.
All right. Definitely good stuff. I definitely agree. My research has concluded that too. And one thing I wanted to get into was around June, oil was around $78.
Right.
And it shot up to $95. And it's corrected a little bit, but you see a differential in the oil price and the energy stocks, and the oil stocks really didn't follow that much of an uptrend as the oil price did. I was wondering what you thought on that, And do you think eventually that the energy stocks are going to catch up to the oil price?
Well, I certainly think in some cases they will. I think there are a number of different factors at play there. One is, as we talked about, the international energy prices. If you look at, say, Brent crude oil, it's actually been a lot more stable at a high level over the last year or so than, say, WTI, which has been much more of a roller coaster ride. Of course, there's been dips in Brent crude oil. I think at the lows last year it got down just under $100 a barrel, but it's been a lot more stable than WTI. And the reason for that is that, as we talked about, these pipeline constraints have caused temporary regional gluts of crude oil to develop, which have caused these wide differentials to open up. But I do think that because Brent crude oil has been much more stable, we've seen international energy stocks that are more leveraged to, for example, international drilling activity or international production. They've performed a lot better than, say, your U.S.-focused energy producers, companies that are, for example, producing oil out of the Bakken Shale of North Dakota. They got hit hard last year when those differentials really widened out. And then they saw a big recovery into the early part of this year when, as you mentioned, WTI rallied back from the upper 70s all the way up to 95 or even a little higher at one point. So I think some of that has to do with just where the particular energy company is based or where their main source of income comes from. I think one interesting sector to keep a close eye on going forward is really the oil services companies. Companies like Schlumberger, which is, of course, the largest in the world, they are mainly leveraged to international activity levels. So if you look at what's going on for them in the United States, business hasn't been great in the United States. The reason is that the U.S. companies face these discounted crude oils. So the environment isn't as good here as it is, say, outside the United States, where they're facing these much higher Brent crude oil prices. So one of the things you've seen out of a company like Schlumberger is they've seen a real boom in international spending. And in fact, they've seen a boom in U.S. spending in deep water because, again, that's offshore crude oil. That's going to be priced more like Brent. And they've seen some sluggishness in the onshore market simply because producers have been scaling back a little bit, or certainly did at the end of last year, because of those wide differentials that opened up. So I think a company like that has more of an international exposure, is a good way to go because I think those prices are going to remain relatively high, and they are seeing an acceleration in growth. And as far as the U.S. producers are concerned, I think it's very interesting and very instructive to look at a company like Occidental Petroleum, which is got a big California business, and therefore they're selling oil at those really high prices. Compare that to a company which is much more focused on, say, the Bakken Shale in North Dakota, and you see big differences in the way those stocks have performed over the last 6 months.
Yeah, that's definitely true. And a lot of companies that are drilling in Louisiana, they're selling at Louisiana Light. It seems like every company's trying to get away from the WTI pricing.
Oh, absolutely. And I think that's going to continue to be the case. You look at some of the Bakken producers that have performed the best, like a company like an Oasis Petroleum, symbol OAS. That company, one of the best things they've done is to arrange rail transportation, basically shuttle cars that carry oil by tanker car from the Bakken Shale area, which is, again, kind of an isolated area. I mean, if you look at it this way, North Dakota, nobody thought North Dakota was a particularly important oil-producing state, 5 or 10 years ago. Now, as of last year, it's the second largest in the United States in terms of oil production. So nobody really built any infrastructure out there, no pipelines, insufficient storage capacity. So there's just a total shortage of capacity to move oil out of that area. And so producers that have been smart and have gone out and arranged for rail transportation, companies like Oasis, like Continental Resources, like EOG Resources, that have arranged for rail transport, actually sit in a much better position because now they can not only rail that oil down to Cushing, Oklahoma, where they can get WTI prices, but they can rail it straight down to the Gulf Coast, where, as you mentioned, they can get prices more like LLS, like Louisiana Light Sweet, or Brent crude oil prices. They're just getting a huge premium to what would be available in an isolated market like North Dakota.
Yeah, that's definitely what I've been seeing. And one sector I wanted to talk about. This is what I'm the most bullish on, is because I think eventually either the Keystone XL pipeline is going to be approved or the Northern Gateway is going to be approved.
Right.
And that is the Canadian oil sands. I see a huge amount of potential because I think their price is just going to skyrocket. And I think China realizes that, and that's why they're trying to buy Nexen and everything. What's your view on the oil sands market?
I would agree with you. I think that right now those companies have kind of lagged because of exactly what we've been talking about, these huge differentials. And when I look at Canadian oil companies or oil producers, one of the key crude oil benchmarks to look at is something called Western Canada Select, WCS. And that's been trading at a really wide differential, not only to Brent, but to WTI. It's been trading at as much as a $20 discount to WTI, which is in turn trading at a $20 discount to Brent. And, the reason for that is that there isn't enough capacity to get that oil down to the Gulf Coast because things like Keystone haven't been approved. But I do tend to agree with you that not only will one of those pipelines get approved, but we'll also see other ways of getting oil to market. One of them is rail from Canada as well. Another thing is that BP has a refinery in Indiana, which has been offline for much of the last year, but has historically processed primarily WCS crude oil. That refinery is currently being expanded and will reopen around the middle of this year, around the middle of 2013. When that refinery reopens, that's going to be yet another source of demand in the very near term for that type of crude oil. So what I do think is that over time we're going to see that differential between WCS and WTI close. And if we're correct and more of these pipelines are built over time, or we see expanded rail transport, that's going to close that differential even more. And that's going to be a huge boon to companies like Suncor Energy, which are big producers in the oil sands of Canada. I would also look at some of the companies that are producing oil in Canada, like Twin Butte Energy is a Canadian company, small producer, produces heavy oil in the Lloydminster area of Canada. And they're going to benefit from this as well because they're trading at discounted prices because of that huge differential between WCS and WTI and Brent. I know all these acronyms for all these different types of oil. But, as we start to see that discount close, I think that's going to be a big boon for the oil sands and for other companies producing out of that area of Canada.
Well, not only that, Twin Butte, which you just brought up, that's actually paying a dividend now. So when they get the price differential, when that starts to shut down, imagine the dividend they can start paying. Absolutely.
I think that's going to be a real boon to their business because they've actually had some, they've actually been somewhat, the reason that that's paying such a nice dividend yield partly is because there has been, I don't think they're going to cut their dividend, but there has been some concern that if differentials remained wide for a lengthy period of time, they might have to cut that dividend. But I do think that, as those differentials close down, people are going to be surprised that they actually may be able to increase that dividend over time. Another company up there that I think is interesting is Enbridge Income Fund. They own a pipeline. They own actually two different pipelines. They own one which is a gas pipeline. But I think what's really interesting is their crude oil gathering pipeline, which is actually right on the border between Canada and the United States. And if you look at that area of Canada, it actually has the Bakken Shale under it as well. So like North Dakota, a lot of producers there are producing out of the Bakken Shale, but it just happens to be on the Canadian side of the border. And I think that this is going to be a big boon for that type of business as well, because as those differentials close, demand for drilling and producing of that Bakken crude oil on the Canadian side is going to explode as well. So that's a little bit of probably a lower risk way of playing this, but I think it's going to benefit all those producers a lot in coming years.
Yeah, and not only that, you look at it, at least this is what I've been seeing, is that a lot of the Mideast countries are trying to, they're consuming more of their own oil.
Yes.
Yet the countries around them are, the emerging markets like China, they're consuming more. India's consuming more. and it seems like Canada is their last resort. Brazil's been producing oil, but I don't think they produce enough to satisfy both. The Mideast is consuming more, and I think Canada is ripe for the pickings for their oil sands for this new demand and take advantage. Do you see that? Or?
Yeah, I mean, Canada, one of the nice things about Canada is, you're right, I mean, it's a large producer. It does have the capability to increase its production and to export more. The other thing about Canada is it's politically very stable. Whereas if you look around the world, I like to say that, we haven't seen peak oil necessarily, but we've certainly seen the peak of easy oil, the easy-to-produce oil onshore in politically stable countries that are easy to invest in is pretty much mature. And what we're seeing companies increasingly do is go to more obscure places or less stable places to try to find oil. Some of the biggest finds we've had in recent years have been in deep water, very technically difficult to produce fields, like you mentioned, Brazil. We've also heard a lot about exploration in places like Africa, not always the most politically stable places of the world, and also subject to disruptions as a result. So, I definitely think Canada in that light is very attractive because not only can it produce more oil, but it's also a politically very stable country that historically has been pretty open to foreign investment and exporting more product. So yeah, I definitely think that it's attractive to these energy-hungry countries. I mean, the fact is that the Chinese know that they're going to need more oil in coming years. And if you look at the numbers, the average American consumes 22 barrels of oil per year. The average person in China consumes 2.2, and that's per person per year. The U.S. has 300 million people. China has 1 billion people. So you can imagine that if China goes from consuming 2.2 barrels of oil per person per year to 5, which is still well under what is the case in the U.S. or Canada or Europe or Japan or any other developed country, the strain on the global oil market in terms of barrels of oil per day would be enormous. And I think we're going to continue to see that, just rapidly rising demand from these emerging markets. And as you mentioned, places like the Middle East, where obviously the rising value of oil actually is positive for their economy and positive for their oil consumption. It's countries like Canada, which have the capability of exporting more, are going to become all that much more valuable.
Yeah. And one other market I wanted to get into was the natural gas.
Yes.
Everyone talks about it. I'm not so bullish on the producers. Like, I personally don't think there's I'm not a big anti-fracking guy. I don't think it's really that dangerous. Like every energy, there's always some risk.
Sure.
But I think the environmentalists are going to get some sort of legislation to make it more expensive. But I think the best way to play it is the transports. What's your view on the natural gas market?
I would totally agree with that, pretty much down the line. I think that it's important, again, to make the distinction between North America, and particularly the United States, and other countries around the world. If I look at U.S. natural gas prices, they're in the low $3 range per million BTUs. If I look at the same gas, the exact same gas in Northern Europe, I'm probably paying 4 times that price or close to it, closer to $12, $10 to $12 for the same exact amount of gas as in the United States. And the reason is, of course, that the U.S. has a glut of gas. All these shale plays around the country, the Marcellus Shale in Appalachia, the Haynesville Shale in Louisiana, the Barnett Shale in Texas. The boom in production from these shale plays just over the last 5 years or so has been so tremendous, it's totally overwhelmed the increase in demand. So even as U.S. demand for gas has been rising lately, the supply growth has totally overwhelmed that. And I think that's likely to be the case for at least a few more years because there's really no way for that price gap to close because the U.S. has no capability of exporting natural gas to a place like Europe right now. I mean, obviously, if I could produce gas in the United States for 3 and ship it and sell it in Europe for 10, that's a huge profit. I would do that if I were able to. And the reason that we're not doing that more is that we don't have any capability to export liquefied natural gas in the U.S. There are several companies that are looking to build out capacity, but it's still going to be a few years before that has a positive effect on price. So when I'm looking to play the natural gas market in the U.S., I would tend to avoid the producers. I would tend to look at companies within the U.S. that are involved in pipeline transportation of gas. The reason being is that, as a pipeline operator, I don't really care whether gas is trading at 3 or 10 because I get paid a fee simply for providing that transportation service. It doesn't really matter what the value of the commodity I'm transporting is. So I would look at a company like a Western Gas Partners or an Enterprise Products Partners that are involved in transporting gas because they are going to need to build out pipeline capacity to serve all these new gas plays we're finding. Internationally, I really like the liquefied natural gas tanker market. Basically, these are companies that own these large specialized tanker ships, and liquefied natural gas, or LNG, is nothing more than natural gas that has been supercooled. So it's cooled to about negative 260 degrees, and it converts into a liquid and condenses. So about the best illustration I've heard is that roughly a beach ball-sized amount of natural gas, when converted to LNG, shrinks to the size of a ping pong ball. And that gas is then loaded onto a tanker ship and can be shipped anywhere in the world and then regasified for use, for use in the importing country. But I think one of the most compelling plays there is to look at companies that are actually own those tanker ships. Typically, those tanker ships are booked under multi-year deals. And the reality is that right now, there are just not enough of them. So the rates that they're able to charge for leasing these tanker ships, for actually transporting gas in the form of LNG, have been rising. So I would look at a company like a TK LNG Partners or a GasLog. These companies are going to benefit because they're able to lease out these tanker ships at pretty attractive rates and, in fact, lock in those rates for lengthy periods of time and earn pretty strong cash flows as a result. TK LNG pays a nice dividend as a result, over 7%. So I think that's a very attractive area. If you want to look at gas producers, I would again focus outside the United States. For example, if you look at a company like Eni, or ENI, which is the major Italian producer, one of their most valuable recent finds is this huge natural gas field they found off the coast of Mozambique, which is off the coast of East Africa, not West Africa, but East Africa. It's probably one of the largest gas finds in the last 10 years anywhere around the world, and they're looking to develop that in the form of LNG. And because prices are so much higher outside the United States and North America, that's actually an extremely valuable asset. Whereas within North America, gas trading at such low prices, it's hard for a producer to even make money or even break even at current prices.
Yeah, I'm definitely bullish. I see natural gas as a big opportunity. My favorite sector of the energy, though, I think if someone plays it correctly, someone can make fortune, is the uranium sector. What's your view on that?
Well, of course, the uranium companies have been through a roller coaster ride over the last couple of years, really over the last 2 years since the Fukushima disaster in Japan. And I think that that's probably been one of the most, the media really hyped it up, and I think a lot of investors assume that the situation is much more dire than it really is. And really what happened was the idea became, after the nuclear accident in Japan, the idea became, the sort of conventional wisdom became that, nuclear power was dead. And certainly some countries did move away from it, in particular Japan itself. Obviously, they closed down all their plants for a period of time. Recently, they've actually started to reopen some of their plants, particularly the ones that are considered less vulnerable to a tsunami. The other country, interestingly enough, that moved away from nuclear power was Germany. Germany gets currently about a fifth of their power from nuclear, and they've actually said they're going to close down all their plants between now and 2022. But the reality is that Germany has always been kind of an anti-nuclear country. They've actually had plans to shut down all their plants in place for quite some period of time. So that's really nothing new. Really all they've done is accelerate their planned closure. And in fact, I think they're going to have trouble doing that. They're already seeing some problems because those nuclear power plants are great baseload sources of power. What I mean by that is that if I have a nuclear power plant, I can run that plant at close to 100% of its capacity reliably for long periods of time. And what they're trying to replace it with is things like wind and solar, which are intermittent. The wind doesn't blow at the same speed all the time. The sun doesn't shine, particularly in a country like Germany, at the same intensity all day long. And so the problem with those alternative energy sources is that you get lots of power fluctuations. There's no way to store power on the grid. The power demanded has to equal the power supplied at any given time. So they're having a real trouble as they take down that baseload capacity, nuclear, and try to replace it with this really intermittent capacity. That's going to be a problem for them. And so I think a lot of countries are starting to see that. Certainly in Japan, we saw last summer, they were faced with some pretty severe power shortages. And remember, this is still the world's third largest economy. And as a result, they started to bring back online some of those power plants that had been closed because they just absolutely need the power. So I think countries are going to, and of course the real source of growth in nuclear power demand isn't the United States, it isn't Germany, and it's not Japan. It's places like China and India. China still has plans in place to rapidly build out their nuclear capacity, and that's going to mean more demand for uranium in coming years. So I think you look at a company like a Cameco, which is the world's largest pure play uranium producer. I think right now that stock is pretty depressed relative to its long-term prospects. Uranium prices have come down a lot, and there's a lot of concern out there about the fallout from this disaster in Japan in terms of countries to slow down their nuclear development. But the reality is that I think a lot of countries that are going to still have to pursue those nuclear plans because they have no alternative. Alternative energy sources like wind and solar aren't really an alternative at all because they're not baseload power. And so I don't think you're going to see a major move away from nuclear in countries like the United States or the United Kingdom or France, which is one of the world's largest nuclear producers. I think that Japan is going to have to reopen some of their nuclear power plants. The new prime minister there, who was just elected in December, has actually decided to prior to him coming into power, they had talked about replacing all their nuclear capacity. He's actually put that policy on review. I think ultimately Japan is going to decide that they just need to modernize their nuclear infrastructure and just make more modern plants or construct more modern plants, and they're not going to be able to move away from it. Germany may have to move away from it, but you know what? I think countries around Germany are going to actually have to build nuclear plants to supply the German market. In fact, we're already seeing that. France is exporting large amounts of power to Germany to offset them shutting down their nuclear power plants. So I don't think the world is going to make a major move away from nuclear. So I think uranium demand is going to continue to be very strong, and I think ultimately that's going to be good news for these uranium producers like Cameco, even if in the short term you see some volatility around concerns about nuclear policy at the government level.
Yeah, I definitely agree. And one of the reasons I love uranium right now is no one's even paying attention to it. So to me, it looks like a bottom is occurring, and you saw Russia buying up uranium-1.
Right, and it's pretty obscure market. I mean, if you look at say the investable stocks in the oil sector and the natural gas sector, it's many-fold times what you see in the uranium. There are only a handful of pure plays out there. The largest by far is Cameco. So there are only a handful of plays. It's a very obscure market, and as a result, I think it tends to get ignored. And that also has an upside, which is that when people do start to pay attention to it, it doesn't take much attention to really get those stocks moving, pretty aggressively higher. And I think your point about Russia is a good one. In fact, this year we have the expiration of the megatons to megawatt program, which is basically a program that was put in place back in the 90s, where we took Russian nuclear warheads and took that highly enriched uranium and basically blended it down into a nuclear fuel. Nuclear fuel is much lower grade than, say, weaponized material. So what they did is they took these nuclear warheads, blended it down to make nuclear fuel, and supplied that to the world market. So that actually helped swell supplies of uranium. But going forward, that's coming to an end. So that's going to be, again, another major source of uranium that's going to have to come off the world market, and is going to have to be replaced by uranium out of mines or some other source. And so, it's interesting that the Russians are getting involved in buying up uranium assets pretty much all over, in different parts of the world, places like Mongolia as well. It's interesting that they're getting involved in that at around the same time that they know that they're going to be taking uranium off the world market. So that may tell you something about, how they feel longer term. The other thing I would bring up about Russia is building a lot of new nuclear power plants. One of the main reasons they're doing that is so that they can afford to export more natural gas to Germany. Germany, of course, needs that natural gas to offset the fact that they're closing down a lot of the nuclear plants. So it's a very odd situation, which is more about geopolitics than reality. But at the end of the day, I think that uranium fuel, the demand for it's going to continue to go higher, and companies that have access to fairly low-cost production are going to benefit.
Yeah, I think you just explained why when Putin imprisoned that punk rock band in Germany spoke out about it. He basically told them about the inequalities of Germany and told them to shut up.
Right.
Basically, and why they just sat there and took it. They need that Russian natural gas.
Yeah, it was interesting at a conference about a year and a half ago. He quipped actually. He actually said at the conference that he wondered how Germany was going to supply heat in the winter. Were they planning to burn wood? And the reality is that I think he knows better than anyone that they need that natural gas, and they're going to need it even more when they start closing down those nuclear plants. And if you look at Europe as a whole, they're extremely dependent on Russian gas imports. Certainly many countries are trying to break that by installing more LNG import facilities. But the reality is that for at least the next 10, 15 years, Europe is going to be extremely dependent on Russian imports. And that's a major problem for them. In the sense that Russian supply has been disrupted several times over the last 10 years, and that's caused some pretty extreme price spikes within the European market. I think the only thing that's saving them right now is that Europe's in the midst of a recession, and therefore their demand for electricity and for natural gas is lower than it would otherwise be. But a healthier Europe is going to have trouble meeting supply for gas, I believe.
Yeah. And they talk about shale gas, Poland and a lot of places being big in Europe. But if you look at it, the anti-fracking movement, at least my research has told me the anti-fracking movement is really big in Europe. And it's like I've read that it's funded by Putin, and this would explain. Would you agree with me why it's funded by Putin?
Well, I mean, I think that your point about there being a big anti-fracking movement is true. Certainly, and I believe France still has on the books an outright ban on fracturing within the country. There's been some resistance to it in the United Kingdom, which is another country that I do think ultimately will have some shale production. But even aside from that, one of the big problems with international shale everywhere around the world. Most estimates expect that China actually has more shale oil and natural gas than the United States. But one of the reasons it hasn't been developed rapidly is that they don't really have, there are a couple of problems. One is that they don't really have the technical expertise yet to develop it. You got to remember that, we've been developing shale gas in the United States since the 80s. So we have a lot of experience and have learned a lot about how to do it properly. The other problem is the United States has a lot of infrastructure in the form of hydraulic fracturing trucks, pump trucks, that can actually perform hydraulic fracturing services. That doesn't exist in countries like Europe, in places like Poland, or in China. Another problem is lack of water. It takes a lot of water to fracture a single well. I mean, you're talking about a lot of these shale oil and gas wells. They may be drilled they may be 10,000 feet deep, and drilled a lateral section or horizontal section of the well could be 10, 12,000 feet long, and you maybe fracture this in 20 or 25 different stages. It takes a lot of water to do that. And in parts of China, for example, where there's a lot of shale resource, there's not a whole lot of water that you can actually use to fracture a well. So I think there's a lot there. Certainly environmental concerns in Europe are a major problem, but there are also other obstacles as well. And I think that you will see countries like China and parts of Europe eventually develop a shale gas and shale oil industry, but it's not something that's going to happen overnight. And I think that, one of the things that I try to stress to a lot of investors is that, these could be concerns for 10 years from now. But the idea that we're going to see a rush of natural gas from a place like Poland or the United Kingdom offsetting the need to import Russian gas in the next 2 or 3 years, I think is just ludicrous. It's going to take a lot longer than that to develop that infrastructure, that technical know-how, and to overcome environmental opposition in a lot of these countries.
All right. And if our audience wants to find out more about you, how can they